crunch is spreading.
Bad news from Freddie Mac had been expected. This was worse than bad. The second largest American mortgage company reporting a $2 billion loss for its third quarter. That amounted to a loss of $3.29 a share compared to a $1.17 loss a year ago. Freddie also reported a sharp decline in its core capital, which fell to just $600 million over regulatory requirements. That, too, was unexpected because it was thought Freddie's portfolio was not so sensitive to the recent subprime devaluations. Freddie indicated it will cut its dividend and raise funds, probably with a preferred stock offering. Stuart Plesser of Standard & Poor's says Freddie Mac's problems raise additional concerns for the entire housing sector.
What's disturbing about it is one, the creep into the more so-called higher quality mortgages, which is what Freddie guarantees, and the second most disturbing part is their capital requirements and the fact that they don't have capital to continue going out and expanding their book of business, which would have implications for the mortgage market in general.
Plesser says that could mean fewer mortgages, and that would put additional pressure on home prices, which are already down sharply in many parts of the country. Building permits fell 6.6% in October to their lowest level in 14 years. Housing starts rose 3%, but are still down nearly 50% from a peak in January of 2006. The Federal Reserve had been signaling it planned to leave interest rates unchanged at its final meeting of the year on December 11th. But economist John Lonsky of Moody's says today's report from Freddie may force a change.
The latest unexpectedly deep losses from Freddie Mac makes it all the more likely that the Federal Reserve will have to ease aggressively in order to improve prospects for an adequate supply of mortgage credit, in order to perhaps preserve the possibility that this spring's peak home selling season for housing will not be a bust, as was the case in the spring of '07 and the spring of '06.
Lonsky says the housing market downturn is already cutting a full percentage point off the GDP. Scott Gervais, Nightly Business Report, New York.
Well, the Federal Reserve is expecting